This Week in Startups is brought to you by ZipRecruiter, the smartest way to hire. Twist listeners can try ZipRecruiter for free. Go to ziprecruiter.com/twist. And Walker Corporate Law, specializing in the representation of entrepreneurs. Visit walkercorporatelaw.com. And Fin. Fin takes care of administrative tasks so you can make better use of your time and be more productive. Try Fin for free by going to fin.com/twist.
Hey everybody, welcome to another edition of This Week in Startups. We usually interview founders or do a news roundtable on this podcast, but once a month we collect your questions and we do an Ask Jason episode. And this is where I candidly tell you the truth about how startups work, entrepreneurship works, angel investing, venture capital, and of course, most importantly, life. So we're going to take 5 video questions and then a couple of questions from the mailbag, and we'll start with Ryan. Ryan asks a video question. Let's play Ryan's question.
Hi, my name is Ryan Husk. I'm the founder and CEO of Culture Force, and we are redefining employee experience and company culture through purpose-driven events and activities. My question is, how do you get people on your team to have the same standard of quality that you have or higher? Is that something that can be taught? I'd appreciate your insight. Thank you.
This is a fantastic question. Thank you, Ryan. If you're a founder of a company, you probably have extremely high standards. You're probably an overachiever and a high performer. And what you'll find is many times people will disappoint you and they will not hit the notes that you want them to hit. They don't hit the level of quality. Why? Well, there's usually 2 reasons. One is they're just simply not qualified. They do not have the skill level. And in that case, you need to either level them up with training and mentorship, or it's that they're not motivated. Now, if the person is not motivated, there is really nothing you can do. You've hired the wrong person. They're not aligned with your mission statement for your company. What you will find is through proper mentorship and alignment with the mission, you will get better results. I'll give you an example. Launch, the company I run, is passionate about our mission statement, which is to support founders and inspire innovation. So if you come work at Launch, our incubator, our syndicate, our fund, you better be into startups and you better be passionate about founders and innovation. If you're not, then you're at the wrong company. And when you set the culture up to be one of passion about whatever the goal is or whatever the product is, then the chances that somebody will say, you know what, this is just good enough, will go down because they have some pride in work. Now, you have to ask yourself when confronted with somebody who doesn't have the skill, if you're going to be able to get them there. I like to use a number system to make this more real for you. Let's say you had a designer and you're unimpressed and underwhelmed with their performance inside your company, and you would rate, I don't know, the landing page they made for your startup, the homepage, a 7. You have to ask yourself, realistically, with training and with mentorship and with meetings, can I get this person to hit an 8.5 or a 9.5? You're not going to get them to 10. They're a 7 designer. You might be able to get them to 8.5. That sounds realistic to me. And I think the time it would take and the number of revisions would be in weeks. Now, if you wanted to get them from a 7 to a 9.5, now you're talking about quarters, maybe even years. Every point up in the design Olympics and the rating system gets harder. So in other words, to get from a 7 and 8 in design might take you a month. But to get from 8 to 9, that might take you 6 months. And to get from 9 to 10, that might take you 2 years. Each of those additional refinements takes longer. That's why at a company like Apple or Tesla, Square comes to mind, any of these companies with amazing design, they have to hire world-class designers with 10 or 20 years experience or super overperformers, and they have to create many, many more versions of products in order to find one that was acceptable to Steve Jobs, Elon Musk, etc. So just be realistic with yourself. Do you have the energy and or time or motivation as the founder to get somebody from a 7 to 8, 8 to 9, 9 to 10? And do you have the mission, and are they aligned with the mission? What you'll find is when people are aligned with the mission, they're going to level up faster because they're going to care. I've had many people who work on the podcast, as an example. I've asked them, hey, can you work on the sound quality? Can you work on this? And they never get it done. Or, Other people get it done immediately and without asking because they heard that the sound was lower quality. And so what I've learned to do in my life is to simply hire people who are super motivated and who have some very significant experience. Now, if you're a younger founder or a founder with less resources, you might not have the cheddar to hire people who can come into your business with a 9 or 10 level of skill, in which case you're going to have to either outsource that function or be super engaged as the founder. So it's frustrating. I hear you. And some people just do not have an attention to detail. That's the other thing. You might find somebody who actually has the skill to do something, but they don't have the will, right? They have the skill, but not the will. They have the skill to be a great NBA player, but they don't have the will to get up every morning at 6 a.m. and do the workouts and then do another workout at noon and another workout at night. Some people have the skill, but not the will. And it's your job as a founder to cut it off if somebody is too frustrating to you, because you need the founder to be coming to work every day juiced up and motivated from the people around them, not the opposite. You don't want the people at your office bringing you down. So take your time hiring and understand when you've made a mistake hiring. That's another key thing I see founders, they do. They don't cut bait. If the person's disappointing you and they're doing 5, 6, 7 level work, you're never going to get them to 9, 10. So define what the standard is. Define if you're willing to put the effort in as well, because it's a two-way street. Okay, let's take another question.
My name is Tristan. I work for a mobile order and payment app in the UK called Ordo. What are your thoughts on this $100 billion Masayoshi Son vision fund? And is it set to take over the tech world's best investments? Or will too much capital lead to reckless investing?
Great question. So, for those of you who don't know, Masayoshi Son, Masa, from Japan, who is one of the great investors and entrepreneurs of our time. He did Yahoo Japan, he did SoftBank, the phones. He brought the iPhone to Japan as well. I know him, I've had lunch with him. He's a super smart, considered an aggressive entrepreneur and investor. What he decided to do was create a $100 billion fund. Where did he get that money? My understanding is from sovereign wealth funds. What's a sovereign wealth fund? It's a fund, a pool of capital controlled by a country. So the sovereign wealth fund of Saudi Arabia, I believe, is the primary investor in the Vision Fund. It's $100 billion. And what Masayoshi Son said to, from what I've heard, people like the sovereign wealth fund in Saudi Arabia was, I can help transition you from an oil-based economy to a tech-based economy, because they know oil and gasoline will eventually go away and be worth much less. They have to flip all of that wealth into something more sustainable. So he was one of the few people who had the chutzpah, the guts to say, I'm going to go big and put that money to work. It's a hard thing to do, to put that money to work. Well, how do you put that money to work when startups are raising 10 million, 20 million, 30 million, maybe 100 million once in a while? Well, what you do is you look for companies that are going to IPO, and you give them their IPO before they IPO. So the perfect example is Uber. Uber did a $10 billion secondary at a $50 billion valuation, and they bought shares from existing investors. What that did for existing investors is it gave them liquidity after 8 years of being in the company, or up to 8 or 9 years of being investors in Uber. It's an 8-year-old company, I believe. So they were able to get liquidity. Masayoshi Son was able to put in 10 billion. If that 10 billion turns into 20 or 30 or 40 billion over the next 5 years, which is likely to do, he would get some percentage of that gain, and cash on cash, they might double or triple it. This money is not going to make its way down into angel investing or seed investing. In other words, they're not going to be putting $10 million or $100 million into two founders with an idea on a piece of paper, unless they're super qualified. This is late stage, and what it's really messing with, if anything, is the IPO process. Some people would argue this is a private IPO. They took the IPO process, which normally would involve retail investors and pension funds, and they just made it a private event where the sovereign wealth, essentially the country of Saudi Arabia, gets to own and do the IPO for Uber or Airbnb or whoever he does next with that huge fund. And my understanding is he's going to do another $100 billion. Nobody's had the guts to do it. It essentially replaces the IPO market, not traditional venture capital, not angel investing. And what it really does is it creates a way for people to get liquidity before an IPO and quicker. So if anything, it's not going to be unhealthy for the environment. It might create a very healthy way for people to work on companies in private while still having the benefit of selling shares from the early investors and from the early employees. So this could be the best of both worlds if done properly. Now, if he gives huge sums of money, to companies that don't know how to put it to work, that could be a problem. But let's be honest, if the sovereign wealth fund from Saudi Arabia or another country, like let's say he had Norway, but I don't think Norway does tech investing, you're talking about trillions of dollars in value. They're not going to have a problem if $1 billion is lost here or there. That's part of the game. So nothing to worry about. Any new capital coming in to technology and to startups, in my mind, is a good thing. So great question. It's an interesting wrinkle that's occurred here in Silicon Valley. And you know what? We had the similar thing happen maybe 10 years ago with Facebook when Yuri Milner came to Silicon Valley and he bought 10% of Facebook for $1 billion and a bunch of other investments, Twitter. And people thought that was crazy. Well, here we are 10 years later. Yuri Milner investing Russian money looks like a genius. Now he invests his own money. Obviously, he made a bunch. But so this happens. It reminds me of when I was growing up, there was a big fear or concern that the Japanese were going to take over America because they had bought Rockefeller Center, I believe in New York, or some buildings there, and they had bought Sony and Columbia Pictures and Columbia Records where I worked. And it turned out they were just great investors and it was no big deal. Of course, we need a two-way street. If Chinese investors or investors from Saudi Arabia are going to be able to invest here, it'd be great if we could also invest in those other countries. And I think that's something that President Trump is, although perhaps it's hard to understand his method, it's something he is acutely aware of and working on. I'm not a fan of how he does stuff, but I am a fan of perhaps looking at that two-way street in giving some fresh eyes to that two-way street and seeing if maybe we could do the same and we could own and have some great rules in China or Saudi Arabia for us to invest. So I hope that that happens in the coming years. But for now, we'll take the money. It's good. Yes. Are you hiring? Well, posting to job sites and waiting for the right people to see it is a waste of your time. No, you need to use ZipRecruiter, which is a platform that helps you find the right job candidates for you. Learn what you're looking for, identify people with the right expertise, and ZipRecruiter invites them to apply for your job. These invitations have revolutionized how you find your next hire. 80% of employers who post a job on ZipRecruiter get a quality candidate through the site in just one day. Think about that. 80% get a qualified candidate in just a day. What are you waiting for? And ZipRecruiter even spotlights the strongest applications you received, so you never miss a great match. And we all know that you want to be able to prioritize and not lose somebody because the great employees, great team members, they don't last long on the market. The right candidates are out there, and ZipRecruiter is how you find them. Businesses of all sizes trust ZipRecruiter for their hiring needs. So right now, Twist listeners can try ZipRecruiter for free. That's right, for free. Go to ZipRecruiter.com/twist, ZipRecruiter.com/twist, TWIST. It is the smartest way to hire. Okay, let's get back to this amazing episode. Okay, let's take another question. This one is from Anastasia.
Hi, Jason. My name is Anastasia Volkova, and I'm a co-founder and CEO of Fluoroset. We do crop health monitoring and decision support for agronomists and farmers. I've got a question. What are your thoughts on the commercialization of the technology that includes incorporation of proprietary data from users? So deep technology startups in agricultural technology, just like us, and in medical space, are struggling with accessing quality user data, but in fact the results and the analytics that we're deriving from it is good for the user. Have you seen this model working in other industries maybe? And what do you think will be the future of using clients' data to actually derive insights for them? Thank you.
Okay, this is a wonderful question. And of course, it sparks a lot of ethical debate and privacy concerns. The data that we've collected on traffic patterns, as an example, let's say Waze, allow us to know when there's traffic anywhere in real time. This is incredibly beneficial to society because You can route around traffic. If the 101 has a ton of traffic, you can take the 280. If the 405 is backed up, you can take Sepulveda. I could give you a million different examples. And the part of that can be concerning is, well, now we know if you're speeding. Waze knows if you're speeding. And also, maybe Waze will route people through a neighborhood. And all of a sudden, everybody, instead of taking the 10 to the 405, or instead of the 405 Sepulveda, now they're going through San Vicente and driving through Brentwood. I'm giving examples in LA. And then that upsets the people who are living locally because Waze has now taught everybody the back roads. The same thing will happen with our data for health. It would be an incredible gift to science and to medicine if we could know the glucose level of every individual in America and correlate it with the number of steps that they've taken. Now we know how active you are from your Fitbit, let's say, or your phone or your Apple Watch, and we know your glucose level. And it would be amazing to know in New York versus San Francisco, maybe mix that with temperature. And now what if we had your DNA? What if we had, any number of other early detection of cancer, et cetera? So this could lead to us correlating and understanding things through artificial intelligence and machine learning. My God, all kinds of interesting ways to prevent disease or know if somebody's high risk. But any data that's being collected will also be compromised at some point. So whether it's the Ashley Madison hack, the Sony hack, there have been many hacks into data that have caused a lot of pain and suffering. We never know exactly what will happen when you collect a lot of data. An example of this is they caught the Golden State Killer, or whatever his name was. It was Golden State Killer, because somebody in his family had taken a DNA test, like a 23andMe test, an Ancestry.com test, to understand where they came from. Oh, am I Swedish, or am I Norwegian? Am I from Ireland or Scotland? I just want to know. Well, it turns out, you probably have 2 or 3 people in your family who've taken one of these tests. They went and they took his DNA and they backed into it. They found his relatives, and the relatives led to his arrest. Is this something we should be inspired by or terrorized by? Well, if we're catching serial killers, it's pretty inspiring that we can find them. However, it does lead to a lack of privacy, and, as I said, anything that is being collected will be compromised. Let me repeat that. If it's collected, it will be compromised. So we as a society have to get used to what happens when these things be compromised. In the case of the Sony hack, there was a lot of fallout from it. In the case of Ashley Madison, I think there probably were a lot of divorce based on that. There are a lot of things that can go wrong, and the technology industry has to take their job super seriously. With great power comes great responsibility. And as we've seen with Facebook, they took all the guardrails off, all the speed bumps, in order to make their business grow faster. And we as investors want businesses to grow fast. Founders want businesses to grow fast. All of these desires to go faster have to be considered in the face of what could go wrong. So this data must be anonymized. It must be accounted for if somebody hacks into it, and you have to use top-of-the-line security. So I feel like we're learning this the hard way. People don't care about privacy as much as they should. And when it comes to health privacy, things could get very ugly very quickly. And so I'm very concerned that the founders who are operating in these spaces are going to need to really protect individuals. And that means anonymizing the data. So if you look at Waze, they're really anonymizing the data. But Google's a data collection company. So if Google does this kind of stuff, you can be sure it's going to be stored, or Facebook. And now we're seeing the EU deciding that they've had enough and they're going to monitor this a little bit heavily. And then you have companies like Apple who are saying, our value proposition is that your data is stored on your phone, not in our cloud. And your data is encrypted on your phone. So if you are a terrorist and if you are a serial killer and you're using an iPhone, it's going to be pretty hard for law enforcement or anti-terrorist groups, the FBI, CIA, to get access to it. These are the kind of things we're going to have to balance, people. And there's going to be an increasingly fervent debate about the protection of society and our privacy, of convenience and solving huge problems and our privacy. The bottom line is you should assume your privacy has already been compromised. Assume every tweet, every SMS message, every Snapchat is being broadcast in Times Square. I write every email and every SMS in my life with the basic premise that it's been compromised. With our health, that's something that's very disconcerting. And I can tell you many stories of people who have explained to me exactly how to use Facebook to find out who's suffering from depression, as an example. I could very easily create an ad saying, are you feeling depressed? Try this solution. You will not believe how effective it is. If I run that ad and I run it against 20 of my friends and I tag 5 of them, right? Like the minimum size audience on Facebook, I think is 20 or 50. If I just put 20 people's email addresses in and I know 19 of them live in New York and one of them lives in California, and I see a California IP address come to my site and that's the only ad I'm running on that landing page, I now know my friend in California is suffering from depression. One of your friends might have done this clever technique to you. Or you could click, once they click on the depression article, and put an erectile dysfunction article right there. They click on that. Now you're getting more information. And the worst part about all of this is that if I put a survey up that asks these kind of questions, you know what? People will take it. And they will not know that they've been individually targeted. And that's exactly what happened with Cambridge Analytica. People took a personality survey. So trust no one, like the X-Files. Assume your data has been compromised and stop using platforms as much as you can, to the extent you can, if they are not good stewards of our data. So a complicated question, an important question. Anastasia, to the extent you're a founder, I think you're going to want to pursue getting this data, but you're going to want to have a pretty high standard for your security and anonymization of that data. Great question. Yes, the Walker Corporate Law Group. Scott Walker has been a friend of the show since the beginning, and he is in fact the longest running continuous partner of This Week in Startups. And the Walker Corporate Law Group is a boutique law firm specializing in supporting startups and their founders, and they encouraged fixed fees. What is a fixed fee? They tell you what it's going to cost to accomplish the tasks that you need to get done. Whether that's mergers and acquisitions, or starting your company, or licensing agreements, your terms of service, privacy policies. All their lawyers have decades of experience, and they're not junior associates learning the job and the craft of being a great lawyer on the job with your startup. They're not experimenting on your startup with their legal. These are serious lawyers who know what they're doing, and they charge a fixed fee because we all know billable hours reward inefficiency. So if you want to talk to the founder himself, Scott Ed Walker, you can call him directly, 415-979-9998, 415-979-9998. Or you can email Scott at walkercorporatelaw.com, Scott at walkercorporatelaw.com. Put Jason in the subject line. Jason sent me. Okay? walkercorporatelaw.com, 415-979-9998. Thanks again, Scott Walker, for supporting independent media like This Week in Startups for, I think, 7 or 8 years you've been with us. I really appreciate that, Scott. And it's great to have built this little podcast with your support to support entrepreneurs, because I know that's what you love to do as an attorney. Okay, let's get back to this amazing episode. If you have a question, you can email askjason@launch.co, send the video to us or a link to a video. Don't put too long of a plug for your startup at the front, or we may cut it out or not accept it. So a modest plug is okay, but not a huge one. Okay, let's take another question. This one is from Daryl.
Hi, Jason. I'm Daryl from Wellington, New Zealand. And my question is, how and when do you value companies in your portfolio? I've recently received a quarterly report from a company, and it gives a share valuation 10x of cost price. It's a private company and therefore illiquid. I'm just wondering, should I mark up my portfolio with the new value or leave it at cost price? Thank you.
This is a slightly technical question, which I'm going to answer, and I'm going to explain it for people who are not investors. When you're an investor, you buy shares in a company typically. And if another person buys shares in that company, you can then know the difference between what you paid for a share and what they paid for a share, and theoretically, on paper, that would be a gain. Now, with the public stock market, this is a liquid device, and so it's almost like a currency. So if I bought a share of Tesla at the IPO of $15 and sold it at $150, or it's at $150 and I haven't sold it, I now know I'm 10x on paper. I haven't realized that gain until I sell it, and then it becomes a taxable event. So public markets are very easy to figure these kind of markup issues. Now, when you're in a startup and you're a startup investor, these companies sometimes are pre-revenue, and many times they're using what's called a convertible note. A note is essentially a loan. A note is a way of saying a loan. So a convertible note says, I'm going to loan you $1 million, or this group of investors is going to loan you $1 million, and it will convert at $5 million or $10 million, or maybe a discount to whatever the next round is when it converts. And that means you actually don't know how many shares you own in the company. You don't know exactly what price it's going to be. You know the cap. I'm going to invest at a maximum of a $10 million valuation in this company, so the $1 million will be worth 10% or so. But you don't know your markup. And so for early stage investors, angel investors like myself or seed investors, we don't worry too much about this. So an example would be in the 6 unicorns, trust me, with Uber, I saw many different share prices. And you look at it and go, well, am I ever going to be able to change my shares? And the last round for Uber, back to Masayoshi Son, I think he paid $32 or $33 a share. The people who bought those shares in the first round, like I did, paid pennies for the shares. So I could make myself feel good in an Excel spreadsheet and mark it up. But the way I look at the world is until that turns to cash, it doesn't exist. So I don't behave in terms of my spending habits or, how I look at the world and my success until it's been liquidated or become a public stock and I own that public stock where I could liquidate it at any time. So I think as an investor, don't get too caught up in the markup game and obsessing over it. I would work on instead understanding which companies have had revenue growth and user growth and engagement. Those metrics are more important than the share price to me in the early stages, and figure out how can I invest more money in the winners. So if you invested in 30 companies, don't worry about the markups, because sometimes the markups result in a zero anyway. If you invested in Fab.com went to $1 billion. One Kings Lane went to $1 billion status, unicorn status. Both of those sold, I think, for $5 or $10 million each. And all the investors were wiped out. They got $0 basically. So you could spend all this time marking it up in your mind and thinking about what your gains are. Until it's realized, I don't think about it. So what I encourage people who are investors in my funds or who are investing alongside me in jasonsyndicate.com, I just tell them, understand what your cash in was and understand how much cash you've taken out. So if you put $250,000 to work in 25 different companies, 10K each, just look at the end of the day, 5 years from now, how much cash has come out. Okay, 250, now you're even. And then how much cash comes out in 10 years. And that's what matters. Cash in, cash out. You can back into what your your yearly increase, your IRR, later on, but don't get too obsessed about it. Focus on finding great companies and focus your energy on investing more in your winners. Because if you found a company when it was worth 10 million, it's now worth 100 million, and other people marked it up to 100 million, that's a good indication that it's going to go to $1 billion, because those people wouldn't have invested unless they could get 10x. So keep investing in your winners. If you need to profit take a little bit along the way and you have that opportunity, I don't blame you if you're cash starved or you want to bank a win early. Great question. Thank you so much, Daryl, for that awesome question. Okay, let's take another question.
Hey, Jason, it's Maximilian. I just finished reading your book and it was truly valuable. Thank you. So here's my question. I wonder if you could give some specific advice, as I've been thinking about becoming a VC scout as you were, and a VC associate, or keep angel investing as I've been doing, and do business development, and potentially raise capital for startups, though I'm wondering if the last one is really worth it. I'm based in Miami, New York, predominantly doing health tech. And a follow-on question is, are you still somewhat of a hardliner on needing to be in Silicon Valley in order to do this job? Or what's your stance on it now that some of these startup hubs are popping up around the country and internationally? Thank you.
Great question, Maximilian. So, Max, I'm going to call you Max if that's okay. Let me take the first part of your question, which was, my goodness, I have opportunities to be a scout, I could be my own seed investor, or I could do consulting for a company. I don't think you need to choose between those. Anything that gets you in the game, in my mind, is good. So if you can be an advisor to a company and get 50 basis points over 2 years, vested monthly for being an advisor, Mazel Tov, awesome. Take that equity early in your career. I certainly did. And then invest in companies, even if it's small amounts. And if somebody invited you to be a scout, you can say, sure, I'll be a scout, but I still want to invest my own money and I still want to be a consultant or an advisor rather to companies. Do all three. Just get yourself in the game, get yourself on as many cap tables as possible of high quality companies. And remember, it's a competition to see who can help the founder the most. So always focus on that. Once you get on that cap table, just imagine in your mind that it becomes Uber or Google and Apple, and think, what could I have done in the first year of Uber, Apple, Google, Facebook, Tesla to help Steve Jobs, Elon Musk, Travis, whoever it is, Zuckerberg. And then you become in the world somebody like Peter Thiel or me, because you did do that and you get credit for that for all of eternity. And that helps you immensely as an investor, because you can say, hey, yeah, call Travis or call Marco from Thumbtack. They'll tell you what I did in the first year of Thumbtack or the second year and how I helped that company. And there's other investors who can, Chris Sacca could say that about Twitter and right on down the line. So more activity equals good. But remember, investing is 1% of the job. Helping and supporting is 99% of the job. Now, let's talk about regions. There are a lot of startup hubs. In the book, I make kind of a funny joke. I hope it's funny. Do you need to be in Silicon Valley to be a great investor? I say, yes, that's chapter 5. One word chapter in the book. My publisher thought it was an error, and they wanted me to fix it. And we told them, no, it has to go in as a one-word chapter. They said it's going to be confusing to users, but you obviously got the joke, so that's good. Sometimes jokes are confusing for people. That's kind of the point. Not everybody gets it at the same time. You can visit Silicon Valley on a regular basis, let's say every 2 or 3, 4 weeks, and do 20 meetings and do as much or more than some angel investors do who live here. I do think if you're optimizing for returns, you want to have access to the deal flow here, because the greatest outcomes have come from here. That doesn't mean a unicorn's not going to happen in LA like Snapchat or New York or Sweden, or certainly China's got a ton. But it does mean if you're in Miami or Orlando, Magic Leap, maybe that's a unicorn. People are investing in it, but I don't know if anybody's realized that money yet. Obviously, Seattle has Microsoft and Amazon. So it can happen outside of Silicon Valley. There are 2 ways to route against that. One is come here on a regular basis, invest in the companies here, but you do have to be here for some amount of time. And it's going to be harder to be helpful to the first part of your question. If you're not here, how can you be helpful? You can't go have coffee with somebody. If you're going to do it in another area of the world, understand that your deal flow is going to be bad, or it's going to be modest. There are just not that many companies being started in Florida that are venture scale. I'm sure there's a lot of mom and pop businesses and a lot of great, $10 million a year businesses, but a $10 million a year revenue business is not a unicorn. You need to get to 100 million in revenue. So if the company can get to 100 million in revenue and it's in your backyard, sure, by all means, make that investment, and you may even get a discount on the valuation because it's not here. But generally speaking, just like Hollywood or New York for finance previously, or France or Paris rather for fashion, there are some places that have very robust hubs, and when you put yourself in the middle of them, you just get lifted with that tide. The rising tide, raises all boats. So I don't know why anybody who was taking this seriously would want to surf a beach with no waves, or one wave every 5 years. If you missed the wave, if you missed Snapchat in LA, maybe you just miss every major opportunity. But the truth is, I lived in LA when I made the Uber, Thumbtack, DataStax, Wealthfront investments. I was coming up here every other week, though, sometimes every week, to look for deals. So understand that you do need to be here if you want to have outsized outcomes. If you don't care about outcomes and you're investing in your local, you're in Des Moines, Iowa, whatever it is, and you just care about Des Moines more than anybody, or you're Steve Case and you care about, whatever neighborhood you're in and you want to make it great again, then, and you don't care about the financial reward, you care about the other intangible rewards like helping people and helping your community, those are valid reasons. But just understand that you're not going to have the return, and you may not be able to be an evergreen fund because you may invest your 250 and get back nothing or 100,000, and then your chip stack is going to go to zero eventually. So what I encourage people to do is, sure, you can invest in your backyard, but come here on a regular basis. Also, if you invest in Florida, your companies are going to be coming here on a regular basis to raise money and get customers. So you might as well camp out here for some significant amount of the year. Layer onto all of this that a lot of people are leaving over the tax issues here and the toxicity of San Francisco. So there is a counter trend that is brewing. You can't light fires and throw bricks through the Google bus and think that everybody's going to want to live in this highly dysfunctional San Francisco city. There's a lot that needs to be fixed here. And all I'll say on that subject is bookmark mayorjason.com. I'm not making any announcements except that I have a domain name. Okay, great question. Okay, let's talk about Fin. I've been using Fin and it is amazing. There are not enough hours in the day to get all your tasks done. And what are your options? You can continue to try to get things done by yourself, or you can change the way you're doing them, or you can try hiring another assistant. That's where we discovered Fin here at This Week in Startups. It takes care of all of our administrative tasks, and this lets us be more productive and focus on the things that matter. So things that Fin can do, Fin can do, schedule a call or meeting, make travel arrangements, you know how long that takes, do online shopping or buying, book your doctor's appointment, maybe even your dentist appointment. I just realized I need Fin to do that for me. I forgot about my dental appointment. And you can help find service professionals if you need a handy person or a plumber. And the results are clear. You will save time by having Fin perform all these administrative tasks. And it's much cheaper than hiring a personal assistant or an administrator. You will be more productive and you will get more done. Like the best assistants, Fin knows your preferences. They remember the people you interact with, and they integrate with your email and calendar. Fin can make calls, send emails on your behalf, pay bills, remember important dates, and automatically get things done for you. It has saved us a ton of time. I'm loving using it. Fin is always available on demand, and you pay for only what you use. So you don't have any fear about, oh my God, am I wasting hours? Nope, you pay as you go. So go ahead and try Fin, and you will love it as much as I do, I am sure. Listeners to my show, you can try Fin for free. Think about that. Go to fin.com/twist, fin.com/twist. Go to fin.com/twist, and you can try Fin for free. Stop wasting your time on all these administrative tasks. Just outsource them to Fin. Get them all done nice and quick, easy peasy, and focus on what you do best. Okay, let's get back to this amazing episode. Okay, let's take some questions from the chat room. Josh Lovey Harris asks, hey, Josh Harris, founder of Pseudo, and if you've never seen the documentary We Live in Public, go find that documentary on Netflix or wherever it is and watch We Live in Public. It won Sundance. It's about Josh Harris, who is a tremendous entrepreneur, who was one of my mentors when I was coming up, and he asks a very important question. Where is the best place to get a slice in New York City? There's a bunch of different places. I think if you ask any good Brooklyn boy or girl what their favorite place is, it should be their local place. So for me, that was Bay Ridge Pizza on 76th and 5th, between, actually 77th now. It was on the corner of 77th. So it's on 77th and 5th Avenue. That's the best place to get a square in Bay Ridge. Get a Sicilian, a square slice, can't go wrong. Gino's on 75th and 74th on 5th has the best triangle or slice, as we call it in New York. So you're going to want to get one slice of each, go from one to the other. Also, if you want the coal brick oven, of course, Patsy Grimaldi's amazing slice. Let's go to another question. This one's from Bruce Curley. He says, what do you think of the unemployment numbers today? Okay, so listen, we're talking about a non-tech issue, but I'm going to give you my tech spin on it. Since the end of the financial crisis and the Great Recession, unemployment numbers have gone down. We are now at historic lows for unemployment. Wages have stagnated a bit, but they're starting to go up. And I think what's relevant here is that this has been obviously a 10-year story. We've had a 10-year bull market, arguably. Some people will argue if it's been a 10-year bull market because we've had two 20% corrections, which would make it not a bull market. But the stock market has largely gone up for a decade. This is the second longest bull market. So what does this mean for startups? One of the things it means is it's incredibly costly to hire people. And there are very few people out there available. And you're going to have to pay them more, and it's going to take longer to find them. When the market becomes like this, you have to get creative as a founder. And you have to look for places where unemployment is higher and where people are going to value the work. An example of this was Yelp had some customer support roles in the East Bay of the San Francisco Bay Area. And you remember there was a famous blog post. Somebody was like, oh my God, how can I live on $12 an hour, $26,000 a year? This is criminal. Jeremy Stoppelman should kill himself. This is the worst human being on the planet. And he said, you know what? You're right. Not that I'm the worst person on the planet, but it's impossible to live in the East Bay probably on $26,000 a year. I'm going to move all these jobs to Arizona or, Salt Lake City, Phoenix, wherever. Boulder, maybe right outside of Boulder, Colorado, someplace like that. And so those individuals now are happy to have the job. Also, Canada, where it's 80 cents on the dollar to hire somebody. For $40,000 or $50,000 US in Canada, you're really giving somebody $50,000 or $60,000. Then you put into the fact that they have a lower cost of living. You could have the best Yelp salesperson come to work for your startup. This is a hack for $40,000 or $50,000, maybe $50,000 a year, if you poach them from Yelp and give them equity. So I am encouraging my startups to understand that low unemployment means that in some cities, New York, San Francisco Bay Area, that it's going to be very hard to find certain jobs to fill. Customer support and sales, in-house sales, come to mind as, I wouldn't call them low-paying jobs. I call them, sort of middle-income jobs. And you're going to have to look to other places for that. The numbers are a little fugazi, whether under Obama, Clinton, Bush, or Trump, in that they don't count people who have stopped looking for work. So the real number is obviously higher. But it does speak to the fact that even with automation, we find something for humans to do. And at least here in the United States, entrepreneurs are creating jobs. These jobs were not created by the government. It's not like the government doubled in size in the last 10 years. We have many more companies in America becoming international juggernauts, and entrepreneurship is alive and well, and we have to nurture it. And if you want to complain about capitalism, I understand that it's sometimes hard to understand how somebody like Jeff Bezos or Mark Zuckerberg could become worth $50 billion to $100 billion and other people can't make their rent or are getting paid $12 an hour at Yelp. The disparity between the top and the bottom number is confounding to people. But the rabid form of capitalism we've chosen in the United States will result in us beating other countries. And entrepreneurship is muted in other countries because there is no $50 billion, $100 billion opportunity for them in other countries, i.e. Europe. So if you want to have crushingly low unemployment, it's created by entrepreneurs who want to win. That's the country that we have built here. We are not a socialist country. We are a capitalist society, a capitalist democracy. So I hope that people understand that we can argue about capitalism, but there is no doubt that it is entrepreneurship and capitalism that has created the low unemployment climate we have today. This low unemployment climate, I can tell you, is not happening in other countries around the world where people are desperate for jobs. So when people start complaining about America, they start complaining about capitalism, you can point them to that low unemployment number and let them know that if you create more regulations and you create more red tape and you create some cap to entrepreneurship, entrepreneurs will go to other countries where they are uncapped. And this is an important lesson for states to learn too. New York and California are both getting crushed in taxes, and great entrepreneurs are leaving to go to Austin, Seattle, Florida, and these places are going to become the new hubs because they don't have state taxes. And the state taxes in some places are getting insane. So incentives are curious. And when you pick an incentive like uncapped capitalism and a very fluid market, like we have here, you can get really great outcomes and massive amounts of wealth created. You can also get a polarization of wealth, which is uncomfortable at times. So it's a complicated situation. If you're uncomfortable with this complicated situation, there's a very easy solution for you. Try to immigrate to the Nordic states, where you'll pay 60 or 70% taxes, but you will be taken care of from cradle to grave if they let you in. But they probably will not. Hard to get into those countries because of how they're set up. Okay, great question. All right. This is a great question. I like these questions today in the chat room. People are asking very non-technical questions, which I like. So Donald asks, tips on being patient. I think being patient is overrated. I think that there is a case to be made for being impatient. We should not be patient about the fact that 30,000 people die on the roads every year and that we are on the cusp of fixing that problem. We should not be patient about the fact that with big data and artificial intelligence, we can cure a lot of the diseases that are killing humans. We should be more innovative. And right now, in the tribal society we have here in America, we spend more time fighting each other and attacking each other for being creative or trying to do new innovative things. And I live and I hang out with impatient people. And I have to say, being patient and waiting for things to change, if you're on the wrong side of history where people are dying, I don't think you should be patient. I think you can be patient with yourself. If you're under a lot of stress, I understand it. But startups and entrepreneurship are about impatient people who want the world to change in their lifetime and want it to change quickly. So patient people generally do not change the world. It's the people who are impatient who change the world. I much prefer them. And I like hanging out with them better. I like people. Sometimes it's the sand in the oyster that makes the pearl, as we say here. Okay, let's take another question. Okay, another question from Donald, who has a lot of great questions. How do you feel about Chinese tech giants? I'm looking at Tencent, bull or bear on this. Okay, I don't want to give you advice on any particular Chinese stock. What I will say is investing in the Chinese stock market and those companies when you're an American or anywhere other than being in China and being a person of influence is a risky proposition because we have a lot of regulation here and a lot of rules. And in China, not so much. And so even though we'll have an Enron or a Theranos here from time to time, in China, the whole thing could be a giant Enron or a giant Theranos. We don't know. They manipulate their currency. Different provinces have different fingers on the scale, and the market can be rigged. And who knows what's going on inside these companies. Over time, I do think that they are trying to trend towards what we have in America, which is a legal system that is fair and balanced, imperfect, of course, but more fair and balanced, and giving you the recourse if something goes wrong, and more transparency and more oversight. So it is a balance. I talked earlier in this episode about too much oversight, too much red tape, too much socialism can result in entrepreneurs not going for the gold, not being aggressive. You don't want to mute entrepreneurship. I don't believe in muting entrepreneurship. I think it holds society back. You do need to have rails. You do need to have guardrails so that things like Theranos don't happen. But I would take a Theranos once in a while and people losing a couple of $100 million on it than not having a 23andMe or another company emerge. And so there's that balance question again, and it's one of those questions that society has to really think about. Okay, Zwan asks, Z-W-O-N, Zwan asks, how can I invest just $1,000 in startups? Okay, great question. There's two types of people in the United States. We'll take it up from a U.S. perspective here. Accredited investors, non-accredited investors. Accredited investors have $1 million in cash hanging around, and I think they make over $200,000 a year is the current rule. You can look it up. And the SEC sets that number. It's a bit arbitrary. It basically means that you have a lot of money, therefore you're sophisticated. Now, we all know people who have a lot of money and are not very sophisticated. And so people have debated accredited versus non-accredited and how we do it here in the United States. I'll put a pin in that for a second, but I'm going to talk some more about that rule and if it's unfair or not in a second. But how can you do the $1,000? I'm going to assume that you're accredited for a second. Say, you can go to jasonsyndicate.com and look at our investments, AngelList, Seed Invest, Funders Club. There's a bunch of different places. And some of the syndicate leads will allow you to do a minimum of $1,000. Some will do $5,000. Some will do $10,000 minimums. And a lot of times if you ask them and say, I'm just starting out, I only want to put $1,000 in, they might make an exception for you if you write a nice email to the syndicate lead. Now, there are new sites like Seed Invest and Republic.co. Those two sites are doing equity crowdfunding, which is a new process whereby non-accredited investors can put in typically $500 or more into a startup, just like accredited investors do. And those are neat, interesting new opportunities. It's only been, I think, 2 years since this has started. And I would say the first year people were just trying to figure it out, and a lot of entrepreneurs didn't want to do it. Year 2 is kind of just wrapping up now, and I see entrepreneurs considering it, which they didn't previously. So that's interesting. And into year 3, next year, I think we'll see a lot more real companies, real established companies who don't need to do equity crowdfunding, do it. What's the upside for them? Well, let's imagine you were Airbnb or Uber for a second, and you have stakeholders like drivers, or in Airbnb's case, hosts. What if you offer the Airbnb hosts early in the life of Airbnb to buy 500 shares for $500? Well, the Airbnb host understands how Airbnb works. They're a convert. They're a partner on the platform. So they might say, yeah, I'll invest 500. And can I invest 500 next month? What if you had 10,000 Uber or Lyft drivers who own shares in Uber in year 2 or 3? This would be a great mitzvah to give to those stakeholders so they have an even deeper stake in the company. So I think that that's going to be the upside. For example, I have Inside.com. Inside.com has hundreds of thousands of people subscribe to email newsletters. Some of them pay. What if we offered those people who already love our product the ability to invest in the company for the product they use? Or LinkedIn would be a great example. If LinkedIn, when they had 5 million users, said, you use LinkedIn, you work in HR, you have a profile page, you update your profile, you're one of the first 5 million users, would you, as one of the first 5 million users, like to participate in our success in the future? This could be very powerful. So I think that equity crowdfunding has so much upside, and I'm really looking for a company in my own portfolio or one I create that could leverage this in some way. Okay, Chad asks, with a rocket ship emoji, advice for recent grads on raising a pre-seed round for a consumer app. With small networks, first-time founders are at a disadvantage, obviously, but the proof of concept and a great beta with great data. Okay, Chad, I get it. You are going to have a hard time as a first-time founder raising capital, obviously, and you're going to need to rely on a great product with improving traction week over week. And you have to take a year-long arc to this fundraise. In other words, keep your burn incredibly low, have 2 or 3 founders in the company who don't need to make a lot of money every month, and just focus on delighting a small group of people and growing it just 5% week over week. 5% week over week growth is over 20% a month, obviously, because it's compounding. And if you can hit that number, 5% week over week in a consumer app, people are going to pay attention. And if you can manipulate that number and understand how to buy growth, so let's say you're growing at 5% a week and you do that for 30 weeks, about half a year. And you get to week 31 and you say, you know what? Instead of growing by 1,000 people this week, I'm going to spend money. I'm going to spend $2,000 buying an extra 1,000 customers. And I'm going to show that I can have my graph go slow and steady, spike it, and then go back to slow and steady. What that will prove to an investor is if they can increase and they know how to add users through paying, it would be worth giving them more money. An example of this might be Thumbtack might be doing local services in San Francisco, and they say, look, we know how to launch a city. We did San Francisco and LA. San Francisco cost us $2 million to launch, but it only cost us $500,000 to launch LA. We think we can launch Orange County and Phoenix and Boulder, Colorado, in the Southwest here at the same time, and we can do 3 for $500,000. So get it down to $150,000. When you start having that credibility, which comes through actions, then it becomes much easier to raise capital. So my wish for you, Chad, is that you understand that the way to get investors is to slowly build up your credibility consistently over time. You say what you're going to do, and then you do what you said. right? You said what you'd do, and then you do what you said. Many people talk about what they're going to do. And then they come back to me a couple of months later, and they've done it. That is very alluring. I say, you know what? It's too early for us to meet. I don't want to waste your time because I wouldn't invest in this company until you had this amount of traction. They come back and say, by the way, we got this much traction. You know what I do? I say, great, come by for coffee. Let's have coffee. We'll talk. Have a hipster coffee. That's what you want to do. Don't look at the relationship with an investor as a binary event. Look at it like a light switch that has that, what do they call it, a rheostat, a dimmer, just slowly getting brighter and brighter and brighter until you've shown a light on how brilliant you truly are. Which, Chad, clearly, as somebody listening to This Week in Startups, you're a pretty brilliant guy. Okay, this has been a great episode. Thank you, Emmy Award-winning producer Jackie. Thank you, director Jacob. Thanks to everybody on the team. Peter and MK keeping the lights on, Matt and Demont running the incubator, Ashley running the syndicate. Good job, everybody. Osgood Presh and Daniel, my young guns, killing it for me, crushing it. We are going to go to Sydney and have the first launch festival there. So if you're in Sydney, go to launchfestivalsydney.com or you're within a 10-hour flight. Come join us. It's going to be a lot of fun. And we're doing founder.university 6 times a year. If you are one of these entrepreneurs like Chad who is grinding it out and you're starting to get a little bit of traction, just a wee bit, apply to Founder University. You'll spend 3 days with me and my team, and you'll hear from the world's greatest investors and entrepreneurs who will teach you. It's very expensive. It costs you $0 to come to Founder University. And then there's the Launch Incubator. If you get consistent traffic, like consistent traction, like we talked about, let's say you have 20, 30, 40 weeks of consistent traction. It can be a little up and down at times, but we want to see the fact that you can start to control that traction, maybe turn the dial if you had money. Apply for the Launch Incubator. Just type Launch Incubator into Google. You'll find us. If you are an amazing founder and you have a deck or a product you want to share with me, write a short email. Don't write a novel. And email it to jason@calacanis.com. It's my job. I read every email. Eventually. I don't respond to all of them. It's kind of hard to do that. But when you're ready and you have your product done, go ahead and email me. If you have great ideas, talk to your friends about them. I don't care about your ideas. I care about your execution. There's too many people with ideas, not enough people out there executing. I spend my time with the people who actually build stuff. So go build. All right. If you love this program, please rate and subscribe us wherever you listen to this podcast, maybe in the iTunes store. And I'm hanging out on our YouTube channel, and I reply to questions in the comments. So if you made it this far in the episode and you want to talk to me, angel investor Jason Calacanis, go ahead and go to our YouTube channel. Just type This Week in Startups into the box at YouTube and comment on any episode. I'll probably see it. I might even respond. I'm doing this as a test. I'm going into, and Emmy Award-winning producer Jackie's hanging out in the comments on YouTube because we understand the cool kids hang out on YouTube. All right. We'll see you all next time. Bye-bye.